So welcome to our webinar on how to pay for long-term care. So there's lots of alternatives out there for people to use to pay for long-term care. But a lot of times you don't think about it, or it's something new, or it's something a little unusual. And so people aren't aware that there are things that you can use to pay for long-term care. Sometimes besides government benefits, sometimes including government benefits. So that's what we're going to be talking about here today. So let me bring up the slides here. So here we are, what we're talking about, ways to pay for long-term care, alternatives that you should know about. So we're glad you're here. Thank you for attending. And why are we talking about this? I mean, really, it's the issue of long-term care is getting bigger and bigger in our country. So between age 65 to 69, 1 in 2 individuals have a chance of a nursing home stay. The average stay is only about 2.5 years, but the problem is it's so expensive. $100,000 to $150,000 probably nowadays for nursing home care if you have to pay privately, which means 50% of all couples lose their assets within 1 year because they don't know that there's assets you can protect and things that you can do to help pay for that care. So we're looking at financial devastation, and people don't understand the programs. So that's what we're going to be covering today. If you have questions as we go, you can put them in the Q&A box or in the chat box. I have both of them up on my screen so I can see what is posted as far as questions. I'll try to answer them as best I can. So what are these ways to pay for long-term care? Of course, first one is self-pay. But if you're trying to pay out of pocket $100,000 a year for a nursing home, slightly less than that for assisted living, and sometimes if you need 24/7 care, more than that for home care to try to stay at home, that's going to be hard on your budget unless you've got a whole lot of money. Some long-term care can be paid by Medicare. We're going to talk about that for a minute. Medicaid is what everybody thinks about when thinking about long-term payment for long-term care, because it's the one government program really that can help pay the room and board if you're in a nursing home and you can't afford it. But there are limits on your assets and income for that. So it's difficult to qualify for, and the rules are complicated. One other way, some folks have private long-term care insurance. There's a number of different ways you can enter into a long-term care insurance contract. We're going to talk about the differences and what kind of plans are out there. Trying to stay at home in particular, we're going to talk about maybe moving in with a child or having a child come and provide care for you in your home and paying for that type of living arrangement or care agreement rather than going into a facility. If you're in your home and you need more money, lots of people are house rich and cash poor, then we're going to talk about reverse mortgages. For those of you who are veterans or who are married to a veteran, if you're a surviving spouse, there are some veterans benefits. And then I have a whole lot of little tips under other assistance that could be helpful for finding help for you at home or elsewhere. So first, we're going to talk about Medicare. So Medicare is your health insurance if you're over 65. And mostly what Medicare is going to pay for is nursing home health insurance and some nursing care following a hospital stay. So in that situation, if you are in the hospital and you have to go to a nursing home to get therapy, rehab, something that's skilled care, then Medicare will pay 20 days in full, and they'll pay up to 80 days more, so a total of 100 days. But in that 80 days, you either have to pay a copay of $194.50 per day, or you have to have supplemental insurance to cover that cost. Medicare Advantage plans differ in how much they will and won't pay, and it's oftentimes hard to get a full 100 days. They want to cut you off as soon as they possibly can. But at-home Medicare coverage for skilled care is somewhat limited. So it's not the answer if you need nursing home type care and you're at home and you're trying to get it. Medicare isn't really going to pay the long haul for that. So it's not the answer for most people for the whole time that you need that kind of care. Then there's Medicaid. And many people have heard of the Medicaid program, sometimes mix it up with the Medicare program. But Medicaid is a government program that can help you pay for long-term nursing home care, some assisted livings, and some at home. In nursing homes, you'd think everybody would be on Medicaid, but it's not really true. Only about 40% of nursing home residents get Medicaid, partly because they don't realize that there is a program and they're spending their money trying to pay privately because that's what they think they have to do, but Medicaid is a possibility. We're going to go through some of the rules. It's hard to get though. So there's federal law that is the Medicaid program, and each state then has to follow the federal law. But even under the umbrella of the federal law, state programs differ, and they differ sometimes even by counties. We all know now that the elder law attorneys in the area in Ohio and the Cleveland area, we know how each county does things, and it's different a little bit. So you have to know how difficult or easy your particular county is that you're working in. So let's go spend a couple minutes and just talk about some of the rules for Medicaid. So for Medicaid eligibility, there are income rules for eligibility and there are asset rules for eligibility. So we're starting with the simplest type of program, which is for a single person. So you're a single person, you have to be in a nursing home or assisted living, or you're trying to get in-home care. For income eligibility, every bit of income that you get counts as a part of what you can use monthly to help pay for your care. Social Security, pension, some veterans benefits, if you get long-term care insurance payments, if you get dividends, interest, anything like that counts as part of your income. And most of your income is expected to be used to help pay for your care or pay for the monthly costs in the facility. And if your income happens to be over what's called the income cap, which is $2,523 this year, you have to set up not only ways to use all your income to pay the nursing home, but you have to set up a special qualifying income trust, or QIT for short. It's a dumb rule, but you have to run part of your income or all of your income through this qualified income trust so that you become, quote, eligible for Medicaid, because your income now going through the trust reduces your income below the income cap, and now you're eligible for Medicaid. I just call it one of the knockout factors. It's a way it seems like Medicaid is trying to prevent you from getting benefits because they're making it so difficult. Now, out of your income, you do get to keep $50 a month for a personal needs allowance. You get to keep enough to pay your health insurance premiums. And there's a way that if you have doctor bills or hospital bills that you still owe, but you're out of money, there's a way to get those past due medical costs paid. Now, asset eligibility. Assets are everything you own. As a single person, you're not allowed to have more than $2,000 in assets. There are some exemptions from the asset rules. You're allowed to have one car if it's used for transportation. You're allowed to have a little plot of ground to be buried in. You're allowed to have a contract that's irrevocable to help pay for your funeral. You're allowed to keep your personal items, your clothing and your furniture and your stuff. And there's a new rule that they're still working on, that if you have a retirement account, I call it IRAs, but it could be a 401k, it could be a 403b, whatever your retirement account is, and you're taking your required minimum distributions, your RMDs, then they won't count the actual account, the retirement account, as an asset against you. You can have more than $2,000 then if part of it is in an IRA or other retirement account from which you're taking your required minimum distributions. They will count the required minimum distribution as a part of your income to help pay for the facility, but the underlying IRA, they won't count. The problem is when you die, there's this nice little program called Medicaid estate recovery. And under Medicaid estate recovery, if you have any assets left when you die, your $2,000, your car, your IRA, they then have the right to go after payment back from those remaining assets that they let you keep and get Medicaid. You have to pay those back to the state of Ohio in order to repay these wonderful Medicaid benefits that you got during your lifetime. So they giveth on the IRA and they taketh away in the end. So that's about, there's lots of ways to plan. This is not about specific planning for any one of these types of options. It's just sort of laying out what's out there. So now, income and asset rules for a married couple. For a married couple for Medicaid, they look at the name on the check. Whose name is on that check, and that's whose income it is. And it makes a difference. All of your income counts just like for a single person, but if the husband's in the one in the nursing home, then his income is what's looked at to see if it's over $2,523 and needs a QIT. And it's the husband's income that can help pay for that $50 a month for that person, health insurance premiums, past due medical expenses. And then down there is that weird thing that MMMNA, it's the monthly minimum maintenance needs allowance for the spouse. So then her income matters, because if her income is below a certain statutory amount, part of the husband's income can be allocated to her to keep her able to live in the community. It doesn't get you very much extra, and is only for housing expenses. They don't care if you have car payments. It's just if you have mortgage payments, that helps with that, and utilities and taxes and things like that. So you got to satisfy the income rules. And then for assets, it's a little different because there's two parties involved. They consider the married couple as a unit. So what they do is they add up all of the assets of the husband and the wife, and jointly, whatever they own, they add everything up pretty much as what's called a snapshot date. It's the first date that you're in a facility, whether it's a hospital or a nursing home, for 30 days in a row. Then my example, the husband who is in the nursing home, he gets to keep his $2,000, his plot, his funeral, and his personal items, and that's it, kind of like a single person. And then the wife gets to keep one car, her plot, her funeral, her personal items, and of the rest of the assets, excluding IRAs, because the same rules with IRAs, they won't count them if you're taking your required minimum distributions. They will take the husband's income to help pay the nursing home, and they'll count the wife's income as money she has to live on at home when allocating any assets from the husband to the wife. But everything else, the spouse at home gets to keep half of the rest of those countable assets, as long as the half falls between $27,480 and $137,400. So for example, if that couple has $100,000 worth of these countable assets, the spouse at home gets to keep half of that 100,000 or 50,000. If the couple has 600,000 of these countable assets, the wife at home gets to keep half, but it's maxed out at 137,400. If they don't have much at all and they only have, say, 25,000 in assets, they get to keep all of it, because the minimum a spouse at home can keep is the $27,480. So the rules are confusing. They make them that way, I think, so that people can't qualify for Medicaid, unfortunately. And they're not going to get easier. They're going to get more difficult. And there's planning tools we have. I'm just trying to give an overview of all the different possibilities for how to pay for long-term care. So we can't get deep into any of the planning rules. All right, long-term care insurance. Now, this is trying to self-insure. You are paying monthly premiums or annual premiums for an insurance policy that will, in turn, if you need to go into a nursing home, assisted living, or you need long-term care, nursing type care at home or in one of these facilities, that it will pay so much per month to help defray the costs. All of the policies are very different. There were a lot of long-term care policies in the past. A lot of the companies that used to offer them have gone out of business because they didn't realize they needed to charge a little higher premium, because they actually had to pay out when somebody went into a facility. So some of them have dropped out of the market, but there's still plans out there. It can cover all different levels of care. It can even cover daycare and some modifications for your home sometimes. The trigger for these kind of policies is typically you can no longer do some type of activity of daily living, ADLs on my outline or on my PowerPoint. Activities of daily living are like bathing, dressing, toileting, transferring, eating, or having a cognitive issue. Typically, if you can't do 2 of those 5 things without assistance, then it can trigger that this would go into effect and it can start paying out this daily amount. There's oftentimes what's called an elimination period. It is a time upfront where it won't pay. You have to make a claim, and then it has to say, okay, well, you got to still be disabled and needing this care for 30 days or 60 days or 90 days before we start to pay. It's often 90 days because that kind of coincides with the Medicare rule that can pay up to 100 days of skilled care before it stops. And then this long-term care insurance could pick up right after that. It usually will pay for a period of time, so much per day for 1 year, 2 years, 3 years, 5 years, or a lifetime. I have a few clients who have lifetime policies, which is very nice, but pretty much you can't get those anymore because it's too expensive for the insurance company. Some of the things you'll be looking for in a long-term care insurance policy is what's called a waiver of premium. That means that when you go into the facility, you don't have to pay the premiums on it anymore. I've had a couple of clients who didn't have a waiver of premium, and they had to keep paying for the insurance while they're drawing on the insurance, which doesn't really help a lot. Also, cost of living increases on an annual or semi-annual or every 2 years basis. And also something called a partnership plan. Ohio has these that if you use your long-term care insurance plan first, and let's say it pays out $100,000 worth of benefits, it's a partnership with Medicaid. And then Medicaid says, oh, look, you paid $100,000 out of your long-term care insurance. We'll let you keep an extra $100,000 of your assets when we're figuring out how much you get to keep. So those are good. Now, those are traditional long-term care insurance where if you don't use it, you lose it. A lot of people don't like that use it or lose it type of mentality. So there are some hybrid plans now too. There are certain types of life insurance policies or annuities that you can purchase. Life insurance, you can even pay premiums over time. Annuities is more of a lump sum payment of how much you want to have available to pay for long-term care, and you annuitize it. And then instead of it just being a death benefit when you die with life insurance, or when you pass away for the annuities, you can tap into those policies to pay long-term care, and whatever balance is left when you die can still pass on to your family rather than just be a use it or lose it type of proposition. But there's lots of different variations. You have to see an agent who sells these kinds of these kinds of policies and these types of hybrid types of annuities and life insurance to really figure out what's right for you. Rental and care agreements. Now, this is really specifically to try to stay at home, whether it's your own home or whether it's in one of your children or other relatives' homes. The child provides either the home or care in either home, or food and other items to the parent. So the child is helping out the parent, and then the child charges either reasonable rent or hourly care or reimbursement payments to the parent. So you can use these rental and care agreements to try to stay at home, and you pay a whole lot less, presumably, to your child or other friend or relative to stay in the house, and you don't have to end up in a facility that you don't want to be in. It's not like home when you're in a facility. The food isn't the same, and you don't have certain freedoms that you do when you're at home. So many people want to stay at home. This is one way to do it. At least until your care becomes so bad that you really need to be in a facility. So we do rental agreements, we do service or care agreements, we sometimes do a room and board agreement, all kinds of different ways. But the way that works is then it has to be a written agreement, very specific as to exactly what is being paid for. Because Medicaid will look at these things suspiciously, like, oh, this is just a disguised way to give your kids some money. And Medicaid doesn't like gifts of assets to kids. If you give away your money to try to get rid of it for that Medicaid eligibility, they will penalize you. They won't let you get Medicaid for a period of time. So this is one way to, number one, avoid going to the nursing home altogether. But if you know that's coming sometime in the future, you can pay your children, and as long as it's a written agreement, very specific, both you and the child sign off on, or you and your parent, in case you're any of you are kids listening in, both parties sign that agreement, and it's very specific to that couple or that family, and it is very specific as to what the rent is covering, what the care is covering. then it's not a gift of the money to the children. You're still transferring, you're still getting the money to to your children or other relative. And it's not considered a gift. It's considered a payment. Therefore, it doesn't impact as a gift would if you're trying to qualify for Medicaid and they're trying to disqualify you because you gave away assets. But it's got to be very specific. They don't like these things very much. And one downside, and sometimes why families end up not doing this, is because the child's income that they get from the rent or the care or the reimbursements, whatever, have to be reported on their 1040 as income, and it's taxed because they're providing a home or they're providing the care. It is income taxable. So sometimes when we have one of these going to a Medicaid application afterward, then they want to see the child's 1040 to make sure that it's reported as income. Otherwise, they'll try to count it as a gift. It was all a sham. You just did it in a written agreement because you were trying to avoid it being a gift. But we do quite a number of rental and care agreements too. So again, this is something, it's very specific to each family. This is just an overview of things out there and not the planning necessarily. So I can't get too much more in depth on that. All right, reverse mortgages. Now, everybody's seen the commercials with the stars like Tom Selleck selling home equity conversion mortgages, HECM loans, or reverse mortgages. I haven't had too many clients do this, but those who have been very happy. So how this works is if you're over 62 and you're living in your home and you own your home, you can tap into the house equity. But it's different than a home equity line of credit where you have to make payments, at least income payment, interest payments monthly until you pay it off. In this type of loan, you're tapping into the equity, but you're not making any monthly payments back. You don't have to make any payments, and you can take money out of your home. So again, if you're house rich and cash poor, this could be a way to keep you at home. You can take a lump sum out if you need to do something big with the house or put in a new roof or maybe make it more wheelchair accessible. You can take out monthly payments like a pension sort of, or you can even have a checkbook and you use it as a line of credit as needed for any of your expenses, including your health care. The upfront costs can be kind of high. So that has discouraged some folks about doing this. And they used to not check to see if your income was enough to pay your real estate taxes and your homeowner's insurance. But they had lots of people were defaulting on these loans because they couldn't keep the real estate taxes up or the homeowner's insurance up. And that's required if you're going to have this loan, because otherwise their equity in the house is going to be at risk because it might get foreclosed on. So, but if you can do this, it's a way to get the equity out of your house without having to make monthly payments. You still own your house. I have so many clients who think the bank owns the house or the mortgage company owns the house, and that is not true. You still own your house, and you can take out, usually it's only a portion of the equity in your home. So if you're in your 60s, you can take out about 60%. If you're in your 70s, about 70%, and so on. So they'll never let you dip into completely getting rid of the equity because they still need that. Because when you either leave your home, like to go to a nursing home, or you sell your home or you die, within 1 year, that loan has to be paid off. And that usually means it's sold, and then the payment is made back to the mortgage company, and whatever equity is left in the home then goes on to your heirs. If it happens to be that the market is down for housing at the time you have to sell it, this type of mortgage includes HUD insurance that will cover any shortfall. So if you owe more on the loan than the house actually sells for, they're not going to go after your family. That HUD insurance will pay off that balance. So I had one lady who broke her hip. She didn't have a whole lot of cash, but she wanted to stay at home and she needed some care in the home while she was rehabbing and getting better. And she did a reverse mortgage and was so happy with it. She was just ecstatic. Another one where a mother and a son were living together. the mother was over 62. They were trying to stay at home, and she took out the reverse mortgage. When she died, he had now become over 62, and he assumed that reverse mortgage, and he was very happy being able to use the house equity before he, instead of just passing that on to the next generation. So again, you have to see a mortgage lender, somebody who sells these and can tell you all the ins and outs of how they work. And I want to spend a couple of minutes on veterans benefits. Veterans benefits, I don't think of as low income, low asset for people like welfare benefits in the community, because this is for people who someone in the family was a veteran and had service and gave to the country. And now if you become ill and you're a veteran, or you're one of the dependents of a veteran, like a surviving spouse. So many surviving spouses have no idea that they can get some VA benefits simply because their deceased spouse was a service veteran. It could be children, dependent children of the vet, or even a parent of the deceased veteran, as long as they were relying on that veteran for help, aid in remaining at home and with their health and with their care. Also, of course, active duty military service members are able to do this, but I'm dealing with typically the veterans themselves after retirement, the spouses or children. So the Veterans Administration doesn't do a very good job as soldiers muster out and letting them know what's available for veterans. So I always try to explain that what benefits there are available, and sometimes it works with a family and sometimes it's not appropriate at that time. So what kind of benefits? The most used benefits when we're talking about long-term care is not disability payments that you can get compensation if you were injured in the service and you had a service-related injury, and you can get a monthly check for that because you're disabled now. These benefits that we use most often in this type of situation are not service related. You don't have to have been injured in the service. You just have to get old and need help, basically. And most people are unaware of this. It can help pay for home care. It can help pay for assisted living and help pay for nursing home care. And what this type of benefit is called a Veteran Service Special Pension Benefit. It's called a special pension, but it's not really retirement payment like you think of as a pension. It's a monthly check, which therefore is kind of like a pension that you can get on a monthly basis. This is not service related. You don't have to have an injury or anything happen in the service, but there are requirements, and there are asset rules, and there are income rules. So, but most often in a colloquial way, it's called aid and attendance. Even though the Veterans Administration just calls it enhanced special pension, most folks know it as aid and attendance, because this comes into effect when you need the aid of somebody else or someone to help attend to you. And you can get pretty decent money every month. If you're a married veteran, typically, husband and wife, usually still it's the husband who was the veteran, you can get as much as $2,431 a month. If you're a single veteran, as much as $2,050 a month. And what hardly anybody knows, a surviving spouse of a veteran can get up to $1,371 a month to help pay for their care, maybe somebody in their home, or help pay for an assisted living. There are income rules. If your income exceeds these maximum amounts that you can get, you will reduce that amount of benefit unless you're using all of your income to help pay for your medical expenses. So insurance premiums, co-pays, deductibles, the cost of someone in your home, which can even be a family member, going back to remember care agreements, you can contract with a child to help pay them for your care, which reduces your income and gets you eligible to become to be able to receive these amounts on a monthly basis. Also, if you're in assisted living, if you're even in independent living, but the doctor says you can't live alone, all of those expenses you're paying reduces your income you're getting already from Social Security or pension, which then if you've reduced your income down to zero and you need more, then you can get these amounts to help make up the difference of what you need. There's also asset rules, something like Medicaid, a little bit more flexible. Whether you're married or single, you get to keep a house, a car, a funeral, a cemetery plot, and up to $138,487 of other assets. So it's sometimes much easier to qualify for Veterans Administration benefits through this aid and attendance program because you get to keep all those assets, and there's no veteran estate recovery like Medicaid estate recovery is. It is just nothing after your death once you qualify. So again, this is an option out there. It requires planning. We usually send people to the Veterans Service Commission in the county in order to get that help from veterans who are employed there, and their job is to help other veterans get these benefits. So also, think about that if you have somebody in the family who's a veteran. All right, this is sort of the other options portion of it. If you're trying to stay at home in particular, there's a lot out in the community and other kind of tips that you can use to try to get help at home at low or no cost, or to tap into money to help stay at home. So I've listed some of those ideas here on this page. The National Council on Aging, wealth of information on their website. In particular, this website that I have in the PowerPoint, benefitscheckup.org. I recommend this to many of my clients to take a look at, and you go to that website, it'll start up a question and answer kind of session. And it will ask what state, where do you live, what is your age, what are you looking for, what kind of help, but it's got all these check boxes, and you go through and you check off all these informational boxes. What do you need help with? How much money do you have? Do you own your home? Do you not own your home? And it will come up with a list of federal, state, county, and local agencies that can help you. So if you don't even know where to start looking for help, that is a great place to start. And it's specifically for long-term care type of services, for services for older folks. And so it's fine. It's filters by that kind of a system. There's also benefits.gov. That is run by the US government. And that covers all kinds of benefits, not just long-term care, but if you need special mortgages, if you need to worry about debt payment and taxes and things like that. It's another site that's very general, where you click on what you're looking for and then answer questions, and it will give you places to talk to, how to get more information, how those programs work, things like that. So the National Council on Aging is national, but it's not run by the government. It's run by the National Council on Aging. So, but either one can give you some good help. I think that the National Council on Aging was more focused on seniors trying to stay at home or get help with their aging issues than the US site, which is kind of all kinds of different things. In the state of Ohio, there's the Ohio Department of Aging. And again, their website has got lots of information. There's local and county service agencies, like in Cuyahoga County is DSAS, Department of Senior and Senior Services, or something like that. You can contact them to find out what services are available for seniors in the area. DSAS is specific to Cuyahoga County, but there are other agencies. For example, the local area agencies on aging. There are, I think, 30-some, there's a great number all across the state of Ohio. In the Cleveland area, it would typically be the Western Reserve Area Agency on Aging. That's sort of the Wayne, Cuyahoga, Lorain, Lake Geauga area. There's something called Direction Home, which is another area agency on aging, which is more south of like Summit and Stark and Medina counties. But you can go to the Ohio Area Agency on Aging, and they can tap you into each of your particular counties' area agencies on aging. And they help find you cash benefits. They can help find Medicaid benefits for you. They can help find services that you might need. They can do an evaluation of your needs and care to help advise your family on whether or not you can stay at home or whether or not this is now time to go into a facility for some reason. So they're very helpful to families. They can even help. So for Medicaid eligibility, you can get these home-based care through the Passport program. They're not paying for the cost of a facility, but they're paying for somebody to come in and help you in your home. Right now with COVID, they don't have any service providers. So I heard a presentation from the Area Agency on Aging, the Western Reserve Area Agency on Aging, and they are looking for caregivers, and they can help. Let's say a child wants to become a Medicaid certified caregiver. They have to get special licensing. So the Area Agency on Aging can help a child, not just with a care agreement that they can get paid, but maybe mom or dad has no money and they qualify for Medicaid to bring a caregiver in, but there's nobody in the community right now on their list. They have no availability to bring someone in. A child can become licensed through the Area Agency on Aging and become a Medicaid caregiver and get paid to care for their parent through the Medicaid program. So there's lots of possibilities of what kind of options for seniors with the area agencies on aging. In Cuyahoga County in particular, there's something called the Mcgregor PACE program. It's the program of all-inclusive care for the elderly. This is an alternative to going on Medicaid. You still have low income and low assets, but they package it differently, and you don't have to go through a Medicaid application per se. You have to have the same type of asset background, but through the Mcgregor, there's a whole Mcgregor nursing home and assisted living facility. And Mcgregor, the company, runs this program, and it's more of a private help with care at home. And it's not just health care. It can also be taking care of your home, getting people to cut the grass, shovel the driveway, things like that. So it's an alternative, but that's only in Cuyahoga County. You have to live in Cuyahoga County. Maybe other counties will start that at some point. As an example, the city of Cleveland provides senior home maintenance assistance for low-income, low-asset folks. There's lots of local senior centers and daycare programs that provide not only services, food, entertainment, information, but they can also provide links to programs and other places that can help provide the kind of care you need to try to stay at home. Financially, a couple of ways that besides getting benefits, if you have a health savings account, that's kind of a new thing, but if you have one, it's a way that you can tap into that health savings account. So it's money you can put away tax-free, and as long as you take it out to pay for medical expenses, you never have to pay the income taxes on that. So you could tap into that to help pay for long-term care. Also, if you have IRAs and other taxable retirement accounts, normally when you have to take money out of those pension plans, those retirement accounts, it's 100% income taxable when you take it out. So you're just paying taxes on what you take out. Now, if you're taking it out to pay a medical expense, so you're still self-funding, but you're paying a medical cost. Now, it's not dollar for dollar, but there is that medical deduction if you're able to itemize your deductions. And if you have high enough medical costs, you'll probably be in that category. So at least it can reduce by taking money out of your IRA to help pay for your healthcare costs. In the right situation, it can be reduced or eliminate the income taxes that you have to pay on taking out that IRA distribution. So these are just other ideas of where to look for care and how best to use your own money, particularly to stay at home on this particular slide. So I've offered all of this information, not a lot of planning under each one, but it's too much information to be able to deep dive into each of them and how it all works. We do webinars just on Medicaid eligibility, or how Medicare and Medicaid work together. So this was so much more than that. We can't really go into the planning tools, but what do you do to protect your family and yourself? Do what you did today. You find out as much as you can about what's out there for long-term care, and as early as possible before you need it, because it's very nerve-wracking. And if something bad happens and you have a health issue and your family is suddenly trying to scramble to get information and who to call and what to do, it's better to have that sort of, okay, I know that these options are out there. I know who to call to get help. And it makes that stress much less of a problem. As far as Medicaid goes, it's not do it yourself. It should be, because it's a welfare program, but they make it so that you're going to fail. They don't want to pay out Medicaid benefits if they can avoid it. Again, it's understanding all these various options. Start planning early. Get professional elder law help. So there's a difference between just an estate planning attorney or just some general practice attorney. I have a specialty. I am certified specialist in elder law, which is so much more than just updating your will or asking a question about how IRA benefits when they're taken out our income tax. It's all of those things. And I have people that I call upon to help who are care managers and care coordinators and companies who help you find the best assisted living facility for you or for a loved one. So it's trying to be, there's all this stuff out there. Let's talk about your care and we can sort it out. One of the other things that's real important to do, and so many of my clients don't, have a last will and testament, a financial power of attorney, a healthcare power of attorney, a living will. If you don't have those and they're not up to date, it's so much more difficult to get things taken care of. If you're in a nursing home or if you've had a stroke and you're no longer mentally competent, you can't set those things up anymore. And they're real important to have in place, especially the financial power of attorney. If you have a spouse that you want to have access to your assets and you've got a joint account, joint bank account, joint investments, but if you have if you've got an IRA account, that is not joint. It's just in your own name. And your spouse is not able to access that money if necessary for paying for healthcare bills or to make changes as to beneficiaries or to tap into it to get the required minimum distributions going, because they're not an owner. Unless you have a financial power of attorney naming that spouse and specifically allowing them to do all of these things that are necessary, they're not going to be able to, and then it's too late. The alternative to having a financial power of attorney, a healthcare power of attorney, and a living will is having to go to court, have the court declare that person incompetent, and then naming a guardian to take care of those things, which is hard to do. It's public record. It's out there. This person has been declared incompetent. Most folks don't like that. And then you've got the court watching over everything, which in certain circumstances might be a blessing because the person isn't real trustworthy, but it's the only one. But in most cases, not necessary. And you can have, as long as there's a financial power, healthcare power, living will, for the most part, financial things can be taken care of, healthcare decisions can be made, and you don't have to get into the court process. I try to stay out of court as much as possible. For some of the planning, some of the asset protection planning we do for Medicaid and other programs, sometimes a trust agreement becomes necessary. And that is a lot more complicated document than some of the rest of them, which are oftentimes forms. And you can't just jump into that on your own. You need to know what you're doing with that. Of all of those, the financial power of attorney is the one document I update more often because the banks change their mind on what they're going to allow a financial power of attorney to do based upon what's in that document. Medicaid has been putting more and more requirements that unless the financial power of attorney says explicitly in that document that this power of attorney can handle these things, they aren't accepting it. And if you're not competent and your power of attorney can't deal with Medicaid, that's a big problem if that's what you need to do. There are very specific rules in there, provisions that have to be in there for future Medicaid eligibility. And many banks are now requiring something called an indemnity clause. This is pretty recent, and Chase Bank, one of the big national banks, kind of started this. They didn't want to be liable if they relied on the document and the power of attorney to say, yes, I need to do this. And it looked like everything in the power of attorney was set up so that, yes, that was okay to be done by that person. And they rely on it in good faith. And they do that thing. Like son goes in and says, hey, I need to take out $10,000. My mom told me to do this and make it payable to me. The bank doesn't want to be responsible and have to answer to a lawsuit if the parent goes, wait a minute, I didn't say that. Why did you give him this money? I want to sue the bank. The bank is indemnified. They can't be sued because they relied in good faith on the documentation and what that power of attorney said. Then you have to go after your son. So if there's no indemnity clauses in the powers of attorney anymore, starting from Chase Bank, who said this is the way to go, all the other banks went, yeah, we're going to do that too. So there are provisions like that, that some financial institutions won't accept the power of attorney unless they're in there. So we say for your documents every 3 to 5 years to check them out and make sure that they still reflect what you want, and maybe have an attorney go, is this enough, especially with the financial power of attorney, is this enough so that we're complying with all the new laws and all the bells and whistles and everything are in there. So thank you for coming. Are there any questions anybody has? Nobody has put anything in the questions and answers or in the chat, which means I must be doing a fantastic job. You have no questions whatsoever. We have a couple of minutes if you want to ask any questions. If not, after the seminar, we do send out the PowerPoint slide pack, so you'll have that. And if we can help you in any way, just call the office. This is what we do. We were trying to help people. Well, thank you for the thank you that somebody sent. Anything else question-wise? How often is an update needed is a question. How often is an update needed to documents, I'm assuming, since that's the last thing we were talking about. Whenever anything in the world, your world changes. So births, deaths, marriages, divorces, health, wealth can all change your situation. Then you have to update. We recommend for our clients, and we send out letters every 3 years saying, hey, take a look at your documents, make sure that they are okay. And if you want us to take a peek at them and advise you as to law changes like the power of attorney I was talking about, then let us know and we can do that for you. Anything else? All right, will you let us know when you have a Medicaid webinar? All right, yes, of course. That's why, we advertise by email, by social media like Facebook. You can always call and check the office. We try to do a series of 3 webinars every month or 2. And we try to vary the topics because we don't want to talk about Medicaid every single webinar. That wouldn't be helpful for the people who aren't interested in that. But pay attention. You can always check on our website calendar. You can call the office and ask, but we do send out the email blast and on Facebook and some of the other social media. So just watch for that. Yes, we will always do another Medicaid seminar because it's always changing and it's always a pain in the butt to try to qualify. Anything else? Is that called an appointment for update? How to schedule an update appointment? Call the office. Debbie is the person who most often answers the phone. She's also my secretarial assistant. And just say, hey, I'm an existing client. I want to come in and have everything looked over, or I'm a new client. I want to make sure my documents are good to go, and we'll schedule usually an appointment. It's not like 15 minutes and we'll just see you real quick and then we're done, which we wouldn't charge for, but we usually have to sit down for a couple of hours to go through all of the documents, all of your assets, see who's titled on what. How do we avoid probate on those assets? How do we update your documents to be the best that they can be and up to date and with the current laws and everything? Are you a veteran or is somebody in the family a veteran? And we'll go through veterans benefits. We go through the Medicaid rules and how it would affect you. And that's why a seminar like this, we can get a little bit more into planning when the Medicaid is only topic in the seminar, but we can't even go into that specific for person by person. So that's part of the thing that takes the most time at an appointment like that, is to go through all the Medicaid rules. So because it's a couple of hours, usually we don't do it for free, but we normally would be $375. But if you are an existing client, or you've come to a seminar, you've been referred by somebody else to come to us, then we usually cut that price to $275. And that's the meeting fee. From there, when we decide we need to do X, Y, and Z, we try to flat fee everything, because people want to know, how much is it going to cost? So, we'll tell you up front how much everything will cost, and you sign an agreement, pay, we get started. So we try to be as transparent and upfront with everything, the costs and what we do, as we can be. How early should you encourage children to plan ahead, especially long-term care insurance? Oh, that's an interesting question. Long-term care insurance becomes more expensive the older you get, of course. So you can get long-term care insurance and some of those hybrid policies as young as age 25. Most children of that age are not even a bit concerned about the future. So it's usually the best time is maybe in your 40s or 50s, because the premium you'll pay there and for the rest of your life will likely be less overall for your lifetime than if you start in your 60s. And by the time you hit 70s or 80s, it might be cost prohibitive, or you might be so sick you can't get one. So at least into the 50s is probably, the sweetest spot for people to do that. But wills and trusts and powers of attorney, that's any age. When you're 18 or over and you're an adult, man, you should have those things in place. And you should encourage your children to get those things in place. And remember, when your child turns 18, you can no longer talk to their doctor or their teacher in college or anybody else without a power of attorney. So you start early on those. Does the trust cover a lot of the information covered? Not necessarily. A lot of this is outside of estate planning documents or trust planning or anything like that. But for Medicaid eligibility, for VA eligibility, when we're trying to protect assets, we often use trusts. A trust can avoid probate. A trust can provide direction and security for your assets. At your death, you can leave them in trust for your children for their lifetimes, to make sure creditors can't touch it, divorces can't touch it, and it ends up with your grandchildren. We call that a bloodline trust. We do irrevocable trusts for Medicaid and VA asset protection, because it has to be you giving it away. You can't touch it anymore. And typically, if you wait 5 years before you apply for Medicaid, or 3 years to apply for VA benefits, you get past this look back during which they would deny benefits, and you can get benefits then. It's a lot more complicated than just getting a new will. So there's lots of types of trusts, and people might or might not need one. Depends upon the family situation. All right, anything else right now? I have a minute or two left. I don't see anything else. So with that, I think I'll close the seminar. And I thank you for attending today. And, let us know any questions you have later, or please come to other seminars that we're presenting. So let me, stop sharing and say goodbye, everybody. Thank you very much for attending, and I'm happy to help anybody with any questions they might have. And we also have referral lists. If we can't help you, we hope we got somebody that we can refer you to that can help you. So have a nice rest of your weekend. Thank you so much for attending, and we'll see you at the next one. Bye-bye.